Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another edition of the weekly economic review, this time for the week ending October 15, 2021. So let's start with something new before we go to the markets. So first, there is something new on the web page ia.ca/economy. So there's an economy and finance 101 section that has just been added. So what you'll find there when you click on that, you'll find access to videos, all videos between 5 and 10 minutes, easy to digest. The idea is to bring a common base of knowledge for advisors, for clients, maybe questions that were very good but you were afraid to ask, or at least things that I find that are very necessary to fully grasp everything that we're discussing in these reviews every single week. So I'm always talking, for example, about inflation. So why am I talking about inflation so much? What's inflation? How is it measured? Who measures it? So there's a video on that. There's one on GDP. So we're always talking about the economy. Well, what indicators are we looking at, and what's how are they important to the markets? And the third one, which is probably the most important one so far, is central banks and monetary policy. What's a central bank? Who's the central banks? What are they doing, and why it relates to the markets? So these are the first three videos. I'd love to have some feedback, so you can write at economics@ia.ca. So economics ICS at ia.ca. Give me some feedback on what you think about the content that's there, the format, and please, if you have ideas of other topics that we should cover, we'll take that into consideration. We already have a list of more videos that we'd love to make, and in the future, we'd love this to be intemporal stuff. If we had dozens of videos there, just a reference for anyone that wants to know more about economics and finance, it's going to be staying there. So it's new. Give it a look and tell us what you think, please. So back to the markets now. So after 4 days this week, positive returns for bonds, positive returns for equity. So 1.8% return on the long Canadian bond index. This week, the TSX was way above every other market. When you bring everything back into Canadian dollars, 2% for the TSX. And as I am recording this, it's just prior to market open on Friday morning, and we're looking at further gains. So it could be more than 2% on the week. Year to date, we're at 22% for the TSX, and there's still 2.5 months to go. So very strong performance for the TSX above S&P 500, NASDAQ, EFI, and emerging market, which is still the only one in negative territory when you bring everything back in Canadian dollars. Price of oil higher above $80 this week. Canadian dollar above 80 cents. Euro up, and gold still volatile but up. So I'll be talking this week about inflation. We're always talking about inflation. And again, there's a video on that in the new Economics and Finance 101 section. So it's still rising. And how big of a problem is it now? So on the left, you see inflation figures, total versus core inflation. Well, the total inflation was above 5% again, and it picked up a little bit during the last month. So we still think that we are near a peak. So the peak should be somewhere around 5-6%. It would be surprising to see it go much above that. And we should see inflation go down slowly at some point, probably through the end of the year. But transitory inflation, yes, transitory for longer than we think. That's starting to be pretty clear right now. So is it starting to be a problem when we look on the right side? Well, yes, because inflation adjusted hourly earnings, so wages. So what we see right now is that inflation is climbing faster than the average hourly wage for the U.S. employee. So that means that purchasing power is shrinking right now. So it's starting to destroy some demand. So starting to have an economic impact, and it should have more economic impact while this thing lasts here. So So it is starting to be a problem. We see confidence indices fall. We see some concerns about inflation. So this is very much a story to develop. But the flip side of that is that if you have stronger inflation and so more bargaining power for business for employees, where you know that there's labor shortages. So labor shortage, and you see more inflation, then what do you ask for? You ask for higher wages. So this is a thing that we are expecting here. So two lines on this chart here. The gray one is a survey of small businesses in the US, the NFIB survey. You can see the gray line is just shooting up like an arrow here. This is the positions that are hard to fill. This is an index. Businesses are really having a hard time filling position. The blue line is wage growth year over year. So as you can see, we should see a pickup in wage growth over the next few months, and it could be quite strong pickup in wage growth from 4% to 5% year over year and above that even. So that should help with purchasing power. But if you have more growth in wages, that should fill into fuel inflation. So that's why we think over the next 5, 10 years, this story will remain something to watch for, and we should have inflation above the targets of the central banks much more frequently than what we've seen over the last 10 years. So inflation is not going away. Is it a problem? Starting to be a problem now. Now we're looking at the reaction of wages. So financial market. So inflation is strong. Last week we had the labor market that was strong in Canada, not too hot in the US, but still strong enough to warrant this, the Federal Reserve, that should be starting to taper its quantitative easing. More on that in the central banks and monetary policy video in the Economics and Finance 101 section. So the Fed should do just like the Bank of Canada is doing now, lifting its foot off of the gas pedal. So less quantitative easing, less buying of bonds on the yield curve, which are keeping interest rates low artificially. So the economy doesn't really need that anymore. So the Fed will probably start tapering. And this is what we learned from the minutes of the September meeting from the Fed, that unless something very surprising happen, mid-November, we should see the start of the tapering all the way through next summer. So the Fed is going to stop growing its balance sheet slowly through next summer. So this is for that part. But the part about raising interest rate, we do think right now that the market is rushing things a little bit. So on the left, you have a chart. This is about the Fed, the probability of 2 Fed rate hikes in 2022. The market right now is pricing in 73% odds that we have 2 hikes in 2022. We do think it's a bit premature. Inflation is caused mostly by supply chain issues, and you're not going to be solving them by raising rates. So maybe one at the end of 2022 would be reasonable with the information that we have right now. Two is a bit of a stretch. And when you look on the right-hand side, the chart there, probability of a Bank of Canada hike on or before the April 2022 meeting, it's 100%. We also think that this is a bit far-fetched. The Bank of Canada should not be rush to hike as much as what the market is thinking right now. So that brings us to the Canadian dollar. So if we are in agreement with the markets that the Bank of Canada will be a bit more preemptive than the Fed to hike rates. It's already well advanced in its tapering exercise. The Fed hasn't started it yet. So if you look at this, and this is an internal chart that you use, sorry, it's not the nicest looking one, but on top you have the fair value model that we've built in-house for the Canadian dollar, the red line. So the red line is the fair value of the Canadian dollar. As you can see, the fair value right now is close to 90 cents on the dollar. The blue line is the current value of the Canadian dollar. So it's close to 80 cents. So there's a 10% undervaluation right now, according to our model, on the Canadian dollar. And so we are pretty bullish on the Canadian dollar. If we do have rate hikes earlier, Canadian economy is a much stronger footing because it has a much better labor market. You could see the Canadian dollar keeping on getting stronger and stronger and stronger. So we really like that team for the next 12 months. We're very bullish on the Canadian dollar. So what to watch next week? We'll have the Bank of Canada Business Outlook Survey for Q3. So we'll have an idea of intentions for investment and hiring hiring from businesses. Always an interesting read. We'll have inflation figures and retail sales in Canada. In the US, it's all about housing, so building permits, housing starts, existing home sales will be coming out next week. So that wraps it up. If you want to subscribe to our newsletter, if you haven't done so, a.ca/economy, you can enter your email there. Please give a look at our Economics and Finance 101 section and give us some feedback. We always want to get better and make sure that we serve you as best as we can. And if you have ideas of topics that we should cover there, please send them to us, economicsics@ia.ca. Thank you, everyone. I'll be back next week.